Private equity. It's the secret weapon of high net worth investors, a powerful tool that goes beyond traditional stocks and bonds. But what exactly is private equity, and why are the wealthy so drawn to it? Today, we'll break it all down, from how private equity works to the benefits, risks, and strategies involved. Welcome back to High Net Worth Living. If you're new here, don't forget to subscribe. In today's video, we're diving deep into the world of private equity and why it's one of the top choices for high net worth investors looking to build and protect wealth. Whether you're an experienced investor or just curious, this video is packed with insights you won't want to miss. Let's get started. What is private equity? Private equity refers to capital investment in private companies, meaning companies that aren't publicly traded on the stock market. These investments are typically made by private equity firms or individual investors and involve purchasing equity in private businesses. Private equity investors seek out high-growth companies that need capital. By buying a stake in these companies, they aim to boost growth, profitability, and ultimately increase the company's value before selling their stake at a profit. A private equity deal might involve buying a struggling company, restructuring it, and guiding it back to profitability. It could also involve supporting startups with strong growth potential or partnering with established businesses to fuel expansion. Why high net worth individuals invest in private equity? So, what makes private equity so appealing to high net worth investors? For one, it offers an opportunity to invest in sectors and companies that have high potential for growth but aren't accessible through public markets. Private equity investments are less liquid than stocks or bonds, which is actually an advantage for high net worth investors. This long-term commitment means the focus is on building value over time, free from the daily ups and downs of the stock market. This approach aligns with wealth preservation and growth strategies, as private equity often targets strong long-term returns that can outpace traditional market investments. How private equity works. Let's look at how private equity investments are made. The process usually starts with raising capital through a private equity fund, which is managed by a private equity firm. Investors, often high net worth individuals and institutional investors, contribute to this fund. Once the fund is capitalized, the private equity firm searches for promising companies to invest in. These investments can vary greatly, from tech startups to established manufacturing companies, and even real estate. Before investing, private equity firms conduct thorough due diligence, assessing a company's financials, market potential, and operational structure. After this, they negotiate terms and invest in the company, usually acquiring a controlling stake. This process is followed by a period of active management. The private equity firm often takes a hands-on approach, bringing in expertise, restructuring management, or implementing new strategies to maximize the company's growth and profitability. Types of private equity investments. There are several types of private equity investments, each with different goals and approaches. Let's break down some of the most common types. 1. Buyouts. Buyouts are perhaps the most well-known type of private equity deal. Here, the private equity firm purchases a majority or total stake in a company, gaining control and implementing strategies to improve its operations and profitability. Buyouts are popular because they give the private equity firm complete control, allowing them to make big changes that can lead to major growth. 2. Venture capital. Venture capital is a form of private equity focused on investing in early-stage companies with high growth potential. Think tech startups and innovative industries. For high net worth individuals, venture capital can be a way to support cutting-edge ideas and industries, though it's riskier due to the high failure rate of startups. 3. Growth equity. Growth equity, or growth capital, is invested in companies that are already established but need capital to expand. This could mean funding new product lines, entering new markets, or scaling operations. Unlike buyouts, growth equity investments usually involve buying a minority stake, so the private equity firm doesn't have full control but can still contribute to company strategy. 4. Real estate private equity. Private equity in real estate involves purchasing properties or real estate companies with the intent to improve and sell them for profit. It's a popular sector for high net worth investors looking for tangible assets. Real estate private equity combines income from rental properties with the potential for capital appreciation, making it a preferred choice for wealth preservation. Potential returns and risks. Private equity offers the potential for high returns, often outperforming public markets, but it comes with risks. Let's break down the pros and cons. On the plus side, private equity investments have historically delivered strong long-term gains, thanks to active management and exclusive investment opportunities. However, private equity is not without its risks. Private equity investments are illiquid, meaning your money is often tied up for years. Additionally, if a private equity firm mismanages the company or the market takes a downturn, losses can be substantial. That's why private equity isn't for everyone. It requires a high tolerance for risk and a long-term outlook, which is why it tends to attract high net worth individuals who can afford to wait out the investment. How to get involved in private equity. If you're a high net worth investor considering private equity, you might be wondering how to get started. There are a few options. One way is through a private equity fund, which pools money from multiple investors. You'll need to meet the minimum investment requirement, which can be quite high, often starting at $250,000 or more. Another option is to become an angel investor, where you invest directly in startups or small businesses. This requires a lot of research and a high risk tolerance, as many startups fail. Some wealthy individuals also form or join private equity syndicates, where they pool their money to make larger investments. Finally, you could consider direct investment if you have industry knowledge and connections. This means investing directly in a company rather than through a fund, but it requires a hands-on approach and deeper involvement. What to look for in a private equity firm. Choosing the right private equity firm is essential for high net worth investors. Here are some factors to consider. Look for a firm with a proven track record, ideally one with experience in your sector of interest. Check out their past performance, industry expertise, and team experience. You want to partner with a firm that has a strong network and can access exclusive deals. Also, consider the fees. Private equity firms charge management fees and take a percentage of profits. Make sure you understand the fee structure and how it might impact your returns.